all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to The Long-Term Investor. I'm your host, Peter Lazaroff, and today we are diving into one of the biggest stories in markets right now, artificial intelligence and its outsized impact on big tech and the stock market as a whole. Investors have poured enormous expectations into AI, even as the broader economy shows signs of slowing. And that creates a fascinating tension between dreaming about the future and dealing with the reality on the ground. To help us unpack this, I'm joined by Callie Cox, Chief Market Strategist at Ritholtz Wealth Management and author of the excellent Substack, Optimistic Callie. Callie's been writing some of the sharpest analysis on technology, AI, and market psychology, and this conversation actually builds on some threads we first touched on together back in episode 136. So in this episode, we're going to explore why the stock market isn't the economy, whether tech earnings can keep carrying the market forward, the risks of overconcentration in the Magnificent Seven, and what history can teach us about once dominant companies like a General Electric or like those of today. We'll also talk about where the real winners of AI might emerge and how investors should balance the story versus evidence. And lastly, we're going to consider what signs would show us that AI's impact is in fact real. As you can tell, it's a very thoughtful, wide-ranging discussion that I really think you'll enjoy. I don't want to delay too much longer, but I do want to remind you that I have a new book coming out next year called The Perfect Portfolio. You can go to theperfectportfoliobook.com. And there you can sign up for exclusive access to early excerpts, to subscriber-only webinars, to some giveaways around the launch time. Lots of good stuff. The feedback of that list has been incredible, so I hope that you will go there and join me on this journey. But without further ado, let's get into my conversation with Callie Cox. Welcome to The Long-Term Investor. Today, we have back with us Callie Cox, Chief Market Strategist at Ritholtz Wealth Management and author of one of my favorite Substacks, Optimistic Callie. I mean, truly Wall Street quality research for the everyday investor. Callie, thank you so much for joining me here today.
Yeah, thanks for having me on. I know we're going to have an interesting conversation. Lots to talk about.
Well, for people who are longtime listeners of the show, if they listened to your interview with me, episode 136, we hit on a topic that I really wanted to dig into. And I think I even said something in the episode that had to do with big tech. And before we get there, let's build up a little bit. You've been writing quite a bit on technology and AI. And recently you've written that investors are all in on AI, even though the economic backdrop looks uncertain or shaky. What do you think Wall Street is doing, and have they become too dependent on AI to carry the market forward?
Well, first of all, I just want to shout you out because at the very end of that last episode, you said we should do a longer episode on tech. And you kept your promise, even if you're a year and a half later. So yes. Good memory.
Yes. I can't tell listeners truly, I actually wrote something down after that I'm going to read at some point during the episode. So do stay tuned to this whole episode. We're going to get into stuff that we started to just scratch the surface of, but you've written on a number of times at this point.
Yeah. And to answer your question, I find this dichotomy so interesting because it really tells a story of why the stock market is not the economy. So the stock market, of course, is built on reality plus expectations. It's okay to dream a little bit because you're thinking about where the economy is going, where corporate profits are going. And if you're tuned into the AI story, I mean, number one, I think it's hard to make the argument against AI being a compelling technology. We're 3 years into this thing. We're finally seeing some adoption. And there's a lot of talk about what could be with AI. That's really exciting. And that's being priced into the stock market. That's being priced into these bigger tech companies, the hyperscalers, the Amazons, the Googles, the Metas of the world. But at the same time, you look at an economic backdrop that shows slowing growth, higher inflation, partially fueled by tariffs, partially probably fueled by some more idiosyncratic stories underneath. And it provides this gap that Wall Street has been trying to explain that's partially natural because the economy is the economy. It's the value we create. It's a pretty hard black and white analysis of what's going on. And then you have the stock market that's building in such high expectations for this freight train of a technology. And the question is, when does one affect the other, Or I would say, when does the economy affect the stock market? And how does that bleed into the AI story and how these companies think about investing in this big technology?
Well, and you mentioned the AI story. Is it all psychology and storytelling, or are you seeing fundamentals driving some of these gains as well?
You're definitely seeing fundamentals drive part of these gains. The percent of them, the share of them is really hard to quantify. But even if you look at GDP numbers, which are as hard and black and white and final as you get in the economy, you can see that there's a lot of spending going on among businesses on data centers, on computing equipment, other indications that companies are investing in AI. I think the number was $1.4 trillion last quarter, which seems like a lot, by the way. It's nothing, peanuts, compared to consumer spending, which is most of the economy at $16 trillion. But even there, you're starting to hear the narrative of AI driving the economy, or at least AI investments driving the economy, which I don't think is quite true. I think that that's a bit of a stretch, but we are seeing it in the data. And the hope is, if this story is true, that the interest in AI and the spending on AI should continue.
And right out the gate, you mentioned the stock market is not the economy. And something that I often find myself repeating for listeners is that when you look at stock market returns, it's usually some mix of change in earnings, cash paid to shareholders, whether that's dividends or buyback, and changes in valuation. And people, when they're feeling confident, will bid up prices despite some weak signals. And I think you've done a really nice job capturing some of what the narratives are behind that, as well as the fundamentals. But the long term, earnings are what really dictate the direction of prices. S&P 500 earnings growth today, pretty heavily concentrated in tech. I believe semiconductors leading the charge there as well. I mean, how sustainable is it in your mind for one sector, or really like one theme, to carry so much of the market's earning growth?
Well, when I say the stock market isn't the economy, I almost want to bite my tongue, because that depends on your time frame. Day by day, the stock market is not the economy. Over weeks, over months, you could even argue that the stock market isn't the economy, because that's where those expectations show up in prices. But over long, long time frames, and I know I'm talking on the Long-Term Investor podcast, so there are probably listeners with these longer time frames. The stock market really does follow the economy more to a T. But when you talk to clients, a lot of them are thinking on a month to maybe year at max time frame, even though they are investing for years and decades down the road. So that line, the stock market isn't the economy, is something I have to say over and over again. Just put like a caveat beside it, an asterisk. But when it comes to earnings growth, typically you want to see all sectors carrying the profit growth that you see. Obviously, you want a strong economy. You want all cylinders firing at max. That's not what we're seeing right now. Tech is actually a large, large share of corporate America's profitability. And to be fair, this has been the case for about a decade. That share has just grown and grown and grown over time. And what you've seen is tech being a little more economically resilient to the ups and downs. And then other sectors like the retailers of the world, the materials companies of the world, the more industrial companies of the world, ebbing and flowing based on where the economy is. So right now we're in a situation where tech's profitability is strong, could peter off in the next few quarters, which I'm sure we'll talk about in a few minutes. But tech's profitability is quite strong, and that's really holding up or masking some obvious weakness in other sectors. So like this quarter, for example, Q2 earnings reports. By the way, Q2 was a chaotic quarter, so asterisk that as well. But looking at S&P earnings, you have a lot of people singing the praises of 10 or 11% year-over-year growth in earnings in a very chaotic quarter where analysts thought it would be around 2 to 3%. I mean, that's a huge beat. But about half of that share above 2 to 3%, that like 7 to 8 percentage point gap, is tech. It's just tech. So the rest of corporate America is doing better than expected, but it's not blowing growth expectations out of the water. And then when you look on a sector by sector level, you see some worrying stories that are more tariff related, are more margin related. You see it in retailers. We saw it in fast casual restaurants. Home Depot reported today and missed earnings for the second time in years. So it's hard to have a foundation that's only driven on one sector. And what you see over history is maybe one sector working better than the others, but eventually caving to the weakness of the others once we hit those economic crises.
Yeah, and it feels like ever since the pandemic, what we would expect to happen, like in an economics textbook, hasn't really applied. Well, I'm saying the pandemic, and what I guess I really mean is 2022. You had these kind of pockets of weakness, and they were like rotating from different areas of the economy. And as a result, different types of companies in their earnings reports and their guidance were getting hit at different times. And today, I think Home Depot is a great call out, where we all know the housing market is at a standstill, and the housing market is often sort of the engine that starts fueling the consumer. And, if not for, say, ChatGPT coming to market and the AI boom, I think it's pretty common among our circles, or, at least in financial circles, for people to say that AI sort of bailed out the market from what was otherwise looking like a weak situation. I guess, in your mind, what risks does it pose if AI adoption slows or disappoints versus what people are currently seeing?
Well, this goes back to tech driving profitability and driving a lot of the expectations in the stock market. Again, the stock market's not the economy, but I like to think back to this Jim Chanos quote about how it's so easy to dream until reality hits, and then investors put a discount on reality. It's so true, even though we haven't seen it in a while. We're at a place right now where a lot of investors feel okay dreaming about AI because the story is compelling, companies are spending. Growth is fine, the economy is slowing, but growth hasn't fallen off a cliff yet. But eventually those frameworks, those textbook theories and textbook fundamentals that we learn about the economy do kick in, and they affect investors' ability to dream, to look into the future and hope for better days ahead, which is essentially what's going on with AI. That's really the crux of it. So I wonder when, and I think the bifurcation of the economy and the bifurcation of market fortunes has been really, really hard to follow. It's been one of the biggest question marks in my mind. But when I think about how I see the world, I always go back to consumer spending. How is the American consumer doing generally? What does the job market look like? Because if Americans are making money, they're spending money, and we're the best in the world at spending money. And right now, I see some worrying cracks in the job market that make me doubt the ability for consumers to grow their spending as much as they have in past years. And it makes me wonder if we are nearing one of those points where consumer spending could slow so much, or the job market could break down so much that that ability to dream could disappear. That's what we saw with the dot-com bubble. First of all, not saying that this is a bubble, also not making a comparison to the dot-com bubble, or not trying to draw clear parallels there, but we had a compelling technology that turned out to be a world-changing technology for a bunch of different companies, drove a lot of profit growth in the 2010s, but it didn't preclude the market from crashing, or it didn't preclude tech stocks from crashing 80% because investors lost the ability to dream. So that's where we're at right now. And I think it's important to remind people that there are, again, pockets of weakness in the economy that have existed for a while. The housing market, for example. And when you have that, you just have a thinning margin on this base for these AI dreams and hopes that the market is running on.
The ability to dream seems so important. And when you were last on the show in early 2024, with technology driving everything, everyone was so willingly dreaming on technology and riding the wave. And I think the big shift, not that much has actually changed, other than it seems like people are coming around to the idea that, hey, like the core business models of these companies, they haven't really changed much in a decade, even as they're chasing new ideas. So like, is it now becoming a little bit riskier to rely on these old engines for growth? But also, I think you're just seeing a bigger case for, or at least a bigger acceptance. You and I have always believed in diversification, but I think investors, especially individual investors, are now maybe looking around and saying, hey, this maybe can't go on forever.
Yeah, I think there's some skepticism there. And I certainly don't want to predict where the AI story is going. I think that that's a fool's errand. Whenever I talk about AI, I feel like I always have to throw a caveat out there that I am not an AI doomer. I think it's a great technology that's going to pay dividends for the economy in 5 to 10 years, most likely. But the path there is what gets really tricky, because you haven't seen any company outside of maybe arguably NVIDIA capitalize on this new technology and start to make obvious sales and profits off of it. So you mentioned big tech and how they're stuck in their old ways. I mean, that's absolutely true. Meta makes a majority of its revenue on ad sales. Google is the same way. I believe about 65% of Amazon's revenue is based on sales, based on people going on Amazon and buying this pet toy that they don't really need. Guilty as charged. But I think people forget that big tech is spending on AI right now, but it's not a core part of their business. And in a way, they're kind of spinning the hamster wheel to see, or like throwing spaghetti at the wall to see what sticks. And while that's fine, that's how you innovate over time, we're not there yet. So you really have to be tempered in how you think about individual companies in this race to adopt AI. And that's where the expectations come in. That's where the dreaming comes in. It's okay to dream. It's just when growth is slowing, when the market feels like it's topping out, then sometimes it's smart to keep diversification in the back of your head and rebalance out of tech, not selling it entirely, but taking some profits, moving them to other more unloved sectors. And I think that's kind of the spot we're in right now when it comes to thinking about portfolios.
Now, when we're saying dreaming, typically people assume good dreams. As I referenced at the beginning of the episode, we had touched on something in our last recording together, and maybe it's more of a bad dream. And just for background, I wrote down some notes when I was doing your show notes back then. And so I pulled those up here that I'm going to read a little of. But for listeners, so I'm 40 years old. A few of my first stock investments, I was gifted like a share of Nike when I was 12, but it was around like my junior year of high school or senior year of high school where I started investing in individual stocks, and in college where I did some more. And look, I didn't know what I was doing, but General Electric was the name. And you think about a company that really just started out in electricity, their bread and butter is building the turbines, the generators, all the guts of the electrical grid. But then they started doing jet engines. They started doing medical technology, television networks. That's the one that really rings a bell in my mind. They even had their own finance arm. They basically were a bank during the financial crisis. The sprawl to ultimately move the needle on their core business really caught up with them. And they were a clear innovator at the time. But over the last 2 decades, the S&P 500 nearly quintupled, whereas GE's market value was cut in half. The last time we were recording, and I guess even now, it basically has split itself into 3 smaller companies. And when I look at the Mag 7 today, I'm not, much like you aren't predicting a tech bubble per se. It's just hard for me not to draw those parallels from GE stories, because I see Apple's iPhone throwing off huge profits, Google and Meta's ad business, Amazon retail, but they're also all going into TV. They're all going into groceries and healthcare and all these things that made them a dominant company start getting watered down. So very long intro into what I want to ask you to chime in on is, for someone like a GE, what do you think investors can learn from looking at history of past dominant companies within the stock market?
Well, I think you have to remember that this is how companies innovate. Good companies try new things and cut them quickly when they don't work. Of course, that's not as easy as it sounds. It's not as easy as like flipping a lever and shutting a strategy off. But these big tech companies are corporate Frankensteins. And all too often, we see it around us in the world. We see that Amazon owns Whole Foods. You can practically buy anything on Amazon, the app, and online. Amazon also has Amazon Prime TV. Like you mentioned, they have a whole TV studio where they're actually developing original content out of that. It is hard to really pin Amazon as one specific thing anymore. And that's worked for them up until now. But if you're starting to think of them as Amazon, the AI company, then I think you really have to kind of catch your breath a little bit and think about that statement you're making. And we don't know yet in this AI race if that's a helpful thing or if that's a weight that they have to carry around, like GE, that ultimately found that it was too big to innovate. And like you mentioned, suffered in a decade where the S&P did really well. The other thing I think about is that Amazon and these other big tech companies have their hands in so many cookie jars, and they're trying to manage all at the same time. So if they're focusing a lot on AI, then they might be pulling resources from other profitable parts of the business. That hasn't happened yet. Profitability is still quite strong among big tech companies, but it's a risk you have to think about, especially as AI spending ratchets up into this year and into next year. The amount of money that they're spending on their AI strategies is insane. So it's always a good reminder to remember what you're invested in. These companies that are a third of your portfolio, if you're an S&P index investor, they're kind of going through their own trial and error periods too. And it's hard to know which one comes out the victor in this AI race in the end.
Well, and I think one thing that also gets under discussed is that the companies that use the technology from these tech companies might be the real victors. So if big tech is the one putting in all the research and development, I mean, I even think about my own job, the amount of benefit and time I'm saved from just basic AI tasks that I didn't have 2 years ago. It's enormous. And I'm just thinking of how are the other, say, 485 companies in the S&P 500 going to apply this to improve productivity and profits? I mean, how do you think about that sort of thing? People will come to you and say, I want to make sure I take advantage of the winners of AI. That's usually what I'm thinking. Where's your head at?
Yeah, and we get that question a lot, by the way. What we do to answer that question, because first off, I'm not a tech analyst. I can't get nitty gritty into tech companies. I always draw that line when we have client questions around it. But I kind of size and scope the universe for them. I remind them that AI is this compelling technology, but it exists beyond these big tech companies and these hyperscalers and these semiconductor companies that we talk about all the time. Data centers are a big point of discussion right now, but they're actually a great example as to how broad the universe can be, because when you think about data centers, you think about real estate, and usually the purest plays in this data center trade are REITs. But these REITs trade like real estate companies, because they are. And people often forget that like the Broadcoms of the world are a big part of the infrastructure when it comes to data centers. So if you apply some really deep thought to these numerous areas that AI touches in the economy and these numerous benefits and kind of chain reactions that AI can have in the economy, then I think you can come up with some really interesting spaces to invest in. And of course, we never recommend spaces to our clients. We're not that nitty gritty, and I leave that up to the advisors. But it is important to just really expand your mind and understand how big this story is and where the benefactors could be, because big tech, as you said, may not be the leader. We don't know. And actually, based on history, it's usually one of the younger, more nimble companies that comes up and catches the bigger companies that are spinning their wheels, trying to catch this innovation.
You know, I think in any period, there's some data that I'll put into the show notes at thelongterminvestor.com where you see that anytime a company becomes one of the biggest companies in the world, their future returns typically go down. It's just harder to move the needle on size. And part of the reason they became one of the biggest companies is that they outperformed leading up to that moment. I think that when people get worried, I mean, I've found myself all year, the big story being like, think about how it impacts earnings. Think about how it impacts earnings. Because we had people worried about tariffs. We have geopolitical concerns. I think people get concerned about the concentration in tech, or what if AI isn't all it's chalked up to be. But recessions, they're pretty normal. AI falling short of expectations doesn't mean devastation. I mean, it might even help separate the hype from the durable innovation. What are you thinking about in terms of those ideas?
Well, concentration in tech poses a lot of risk here. So if you think about the fact that about a third of the S&P is concentrated in the Mag 7 names, and many of them are powered by this AI trade, then AI headlines that threaten the Mag 7 or on a day-to-day basis kind of question what the Mag 7 is doing can hit your portfolio a lot harder than these smaller companies or sectors that typically don't move the needle as much. And look, it drives me crazy when people say like, oh, you're a long-term investor, ignore the daily moves, because we're all human here. If our portfolio is swinging around by 2 to 3%, thousands of dollars per day, we're going to feel it. We see the headlines, we see the stress in markets. Ultimately, your portfolio success partially hinges on the decisions you make on those stressful days. So I think that there is a lot of risk there. And we saw that, especially with DeepSeek. I feel like that's the common example people bring up. But in January, NVIDIA got slaughtered by the headlines around this new Chinese AI tech that was supposed to be super energy efficient and a lot faster and a lot actually more effective in computing out AI results or LLM results than the US LLMs that were already at the forefront of the conversation. And DeepSeek ultimately ended up being a temporary story. I don't know if it pops back up in the future, but it showed us just how much risk is bundled up in these surprise headlines around the AI story. And again, 10 years down the road, these headlines don't matter. But what they do is they kind of throw your portfolio around in the interim, and they challenge you to really have a strategy and really have a good philosophy as you navigate these storms. So It's just something to think about. It's something where I feel like a lot of strategists and experts kind of brush it off and they say, well, the long term matters and that's it. And it's like, no, like we're all seeing these stock prices whip about and we're all more exposed to them than we've been in the past. So it's definitely something to think about.
Yeah, I appreciate that perspective. I mean, sort of like when you look at long-term returns and investing looks easy on paper, but it's really difficult to actually live through in the moment. And so much of our species thinking is tied to stories and trying to seek understanding. And a theme you've been touching on a lot seems to be like dreaming versus reality in investing. So maybe I'll just ask directly, like, how do you feel like long-term investors should balance story and evidence in this moment right now?
Wow, that's such a good question because my analyst brain goes to quantifying that and you can't quantify it. I wouldn't be scared of stories. I wouldn't be scared of expectations. People talk about PEs all the time. I think looking at the S&P's PE in isolation is a bad way to make judgment calls on markets because, again, you can't quantify how much dreaming is okay in a moment or how high expectations could be in a moment. That's a really good way to get burned. So don't be scared of expectations. Don't be scared of stories in the stock market. If you reach a certain level of wealth, you could argue that investing in stories isn't a particularly bad idea if it's a small part of your portfolio. But if you're one of those long-term investors, if you're investing for retirement, even if you're in retirement and you hope to God that you're going to live 20, 30 more years, as I hope you do too, then you have to remember that investing takes a little bit of risk, but that risk looks a lot more like reality, what reality will be in 10 to 20 years. So expectations matter a little bit more in the short term. Expectations can matter if you're trying to craft a portfolio that fits your interests after you've hit a certain milestone with your wealth. But ultimately, reality is what drives your portfolio forward.
Just a couple more questions kind of on this thread. I guess, are there signs that you would watch for that the dreaming phase has ended?
I always go back to the job market there. And maybe this is my framework becoming too obvious, but again, consumer spending is such a big part of the economy and the job market is such a big source of primary incomes in America that you just see it time and time again when you look at economic history. The job market really is the engine of the economy. So for me, I'm looking for higher layoffs. I'm looking for higher unemployment claims. We're at a point with the job market where there isn't a lot of hiring going on. Corporate America is frozen. And actually, that's led to some deterioration in higher unemployed populations. We also have a separate story going on with the labor supply not growing, which can keep the unemployment rate depressed, but is ultimately an unhealthy trend for the economy over the next few years if you consider that GDP is output per capita per head. But that's another thing we can go down later.
I know that's like another, I'm sitting here being like, oh, that's the next episode that we're going to dive deep on. This keeps happening to the latter end of conversations. I'm like, well, there's an hour conversation.
Well, it's so ironic because the optics of unemployment right now are influenced by the labor supply not growing, which is an immigration story.
Yes. And without being political, it just is what it is. Our immigration policy reduces working population and economic growth is productivity and changes in working population. It's as simple as that.
Yeah, it really is. But it kind of muddies the signals that you get from the job market these days. Anyway, we see deterioration in the job market. Often when you see weakness, especially on the unemployed side versus the hiring side, that tends to accelerate quickly or it makes the economy very, very vulnerable to bad headlines, bad shocks. So for now, we're really trying to ground investors in what is, reminding them that if you are a long-term investor, if you are investing on reality, then you should be a little worried right now. You should make some plans as to what could happen if stocks drop 10 to 20% or what you could do if stocks drop 10 to 20%. Fill up your emergency fund. Think about your borrowing strategy if rates come down, especially on the shorter end. And that's where you bring the Fed in. We're trying to remind them that you are living in an optimist world, but right now, so many trends are slowing that it's important to think about the cushion side of your portfolio and the decisions you ultimately have to make on those wild days that drive us crazy that I hope aren't in our future, but trends are pointing to there being a weaker economic foundation over the next few months.
Yeah, more fragile, less room for error, less room for unexpected shock, which every bad market starts with some risk that nobody's talking about, that unexpected shock, and can we really absorb it? So let me, though, finish maybe with something a little bit more positive. On the other end of the spectrum, what would convince you that AI's impact is arriving faster than expected?
So there are actually a few data points that are convincing me that AI adoption is happening, which is great. This is what you should expect. There's a census survey on businesses adopting AI, which is a survey. It has its own, it's not a hard data measure, but you see the use of AI among businesses taking up pretty significantly quarter after quarter, which is, again, great. That's what you want to see. You see a lot of spending on AI. That goes back to like the AI investments part of the GDP that we've seen this year, just growing at a bonkers rate while consumer spending is kind of petering out. I want to see companies talk about actual application. So in earnings calls, I know the Dells and the Accentures of the world have talked about how AI has optimized their workforce and has played into their day-to-day stuff, which is a good sign. It's really, really hard to put your finger on the value of AI right now, though. I would want to ultimately see higher productivity gains, which are really hard to ascribe to one thing. But if you're looking like years down the road, then ultimately, if a technology is adaptable and is beneficial for the economy, you want to see it show up in productivity. So eventually I do want to see that. But we're not there yet. And it's okay. Technology takes time to adopt and really work into your day-to-day routine. I was actually listening to a podcast episode. It was a plain English episode with Cal Newport, who's well known for his research on deep work and productivity, exactly what we're talking about. And his line in the sand is, if we can ever get AI to the point where it can clean out an inbox. And if you think about that, that's actually a really hard task, because when you're emailing, you have to think of the idiosyncrasies of who you're emailing and what you're saying. It's not just this automated, throw it into ChatGPT and let it happen. I wouldn't do that with my inbox. I care too much about personalities and relationships that I'm trying to maintain. So there could be some interesting, more qualitative benchmarks that we could hit there. But I don't think we're there yet. And that's fine. That's expected.
I am with you. I don't think we're there yet in a lot of my indicators. I'm just still surprised how few people that I interact with are using it multiple times a day. And I feel like a power user at this point. I consider myself to be a purist. I just use ChatGPT. I don't know. What's your preferred platform? Are you Claude or Perplexity or ChatGPT?
I need to do more exploring on this front, but right now I'm pretty stuck to ChatGPT and Claude. Claude for more research-based questions, and ChatGPT as like a replacement to Google. Kind of like a ChatGPT, I have chicken in my fridge, what should I make tonight type of thing.
I'm taking lots of pictures with ChatGPT and be like, how do I fix this? Or how do I cook this? Or tell my kids what this is when we're on vacation. Tell them a story that'll make this interesting. That's, everyday life. I feel like people need to stop going to Google and really get ChatGPT on their homepage of their phone and just find more and more excuses to use it. And you'll become amazed.
Yeah. And that's the most exciting part of AI to me, is talking to people and hearing about ways they use it, and then having a light bulb go off in my brain and say, wow, I never thought about using AI for this. I had that moment actually yesterday, and I wish I could tell you the use because it was brilliant. But coming across these daily use cases for AI that can just simplify so many things in your life. But listen to what we're saying too. Replace Google with ChatGPT. Google obviously has Gemini, so they have their own LLM, and they're like, replace Google with Gemini, please. But these are the conversations we're having. It's not a zero-sum game, but in a way, it challenges how we've used the internet for so long. So just something to think about as you see AI stocks in your portfolio and you think about what the typical AI names are.
Well, Callie, this has been fantastic. I mentioned at the top of the episode that you have a Substack, Optimistic Callie, that I will link to in the show notes. Where else can people follow along with your great work?
Well, you can find me on Twitter. I'm at Callie A. Bost. I'm not as active on there as I usually am. I'm on Instagram under that same handle. I'm on Blue Sky, LinkedIn. I'm in all the usual places, but the best place to find my work is through Ritholtz, through the media, and through Optimistic Callie.
Full endorsement here for your Substack that I read religiously. One of the best things that hits my inbox. And if you are watching us on YouTube, you should like us, but also subscribe so you don't miss any more episodes ever. If you're listening to us on podcast platforms, we really appreciate feedback and reviews. Any great words that you have to say about Callie, I promise I will pass along to her.
None of the bad words, though.
I won't. Well, there won't be any. But yes, I will also protect you. I'll protect you from the constructive criticisms that might come your way. The YouTube commenters are a little more hardcore than the podcast commenters. We love you all. Thanks, as always, for listening and watching. And until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.